This is the training program of PAL Network for support of the Roma entrepreneurship. Lesson 7: Financial Management. In this lesson, we're going to explain what are small-medium enterprises, its life cycle, and other important concepts of this type of companies related to financial issues. The definition of micro, small, and medium-sized enterprises is a function of the number of persons employed and the turnover or the total balance sheet. Micro, small, and medium-sized enterprises are the driving force behind the European economy. In fact, small and medium-sized enterprises accounts for 99% of all enterprises and provides 2 out of 3 existing jobs in the private sector and 80% of new jobs. They contribute with more than half of the total added value generated by businesses in Europe. This type of companies can be categorized in a quantitative way by the number of their employees, turnover, or by their total balance sheet. For example, a microenterprise is defined as an enterprise employing fewer than 10 employees, whose turnover or total annual balance sheet does not exceed 2 million euros. In contrast, a small enterprise is defined as an enterprise which employs fewer than 50 employees, and its turnover or total annual balance sheet does not exceed 10 million euros. On the other hand, a medium-sized enterprise is defined as an enterprise which employs fewer than 250 employees, and whose turnover does not exceed 50 million euros, or its annual total balance sheet does not exceed 43 million euros. In addition to quantitative criteria, which can be relatively easy to calculate, they can be categorized as well by qualitative criteria. For example, its simplicity and flexibility in its management, its production of quality products, its rapid adaptation to market and technology requirements. They have better working relationship than large businesses. They are closer to employees, suppliers, and customers. Its flexibility and speed of decision making, and it's mainly based on self-financing. The life cycle of this type of companies consists of 5 steps. It first begins by the visualization of an opportunity, the idea detected. At this stage of introduction, the entrepreneur examines all the economic circumstances. He or she thinks about whether or not to create an investment. Then it goes to initiation, in which the company tries to finalize the location where it will be installed. It seeks associates and executives to frame and make up the workforce, recruit staff, and develops the object or the service it will produce. Also, the company seeks cooperation with customers, wholesalers, retailers, and creates a sales network and concludes agreements for the supply of raw material with suppliers. He makes a complete business plan. Prior to the start, the necessary licenses are obtained when the company falls under one of the particular categories, for example, the sanitary sector. A feature of this stage is uncertainty, very personal work, unforeseen delays, and unpredictable cost and lack of confidence both on the part of suppliers and customers. Serious problems are being created due to the increased cost faced by them, and particular effort is needed by the management of the small and medium-sized enterprises to tackle the situation. Development phase. Once the initial difficulties have been overcome, the company is trying to gain a reputation for developing all its potential and taking part in the market. It needs to adapt the business plan, the marketing plan, the product and service, and so on. It defines the mission and the purpose of the business and establishes a strategy based on the entrepreneur's belief. All the necessary departments have their workforce. The administration is run by selected executives headed by the entrepreneur. This phase can last for a long time. Towards the end of this phase, there are other strategic dilemmas, such as expansion strategy and corporate partnership. These companies need to define their business objectives very clearly and take advantage of both the technological advantages they can have or acquire and their human strengths in order to survive in this particular economic space. It must, at this stage, be and seem strong to its competitor and even to big businesses to able to survive. Fair competition in which it should move is one of the key factors that it should seek to distinguish. In the development phase, many businesses abandon. They struggle due to lack of goals or immaturity. Maturity is the stage where the business begins to achieve a satisfactory turnover. Trust is at a high level. Its suppliers and credit institutions are willing to cooperate to finance the needs of the growing business. At this stage, the company's products get a name and the demand from customers increase. Customers and suppliers are looking to collaborate with this business without much effort. The organization of the business has been completed and its organization chart is final and real. Strategic planning is needed to avoid bending. It's the time to create innovative ideas. At this stage of maturity, the entrepreneur begins to think what happens next. Will the business continue to grow and turn into a major or fall? Recession and decline. Finally, at the stage of bending, the entrepreneur has rejected a variety of ideas and the business is starting to decline. It is beginning to face a drop in sales, turnover is shrinking, profits are drastically reduced, and it has a cash problem. The loss of confidence of both its suppliers and credit institutions is now evident. Its technology is usually old and cannot replace it, and the cost of direct labor is high. Its capable executives are starting to move away from the business, so all departments are down and consumers are looking for new substitute products to meet their needs. The company is in the last stage before bankruptcy and attempts to sell its low-priced stocks at low cost and then liquidate its fixed and investment goods to meet its cash requirements. Cash is no longer sufficient for any need. This stage is the last one and tries to look for the most painless way to stop working. Through all the cycle of small and medium-sized enterprises, there are several challenges. The most common are difficulties in supply raw materials in terms of price and quality, small production capacity to cover large orders, financing liquidity, limited financial resources, and the difficulty of long-term bank borrowing, limited trade organizations and sales network, small number of specialized executives, uncertainty about the future, there is no training plan, increased operating costs, the loss of implementation of law, the rapid growth of illicit trade, and the increasing oligopolization, difficult approach to subsidized funding programs, and the bureaucracy when establishing and licensing. There are two crucial actors in the management of small and medium-sized enterprises. On the one hand, the entrepreneur in the small medium businesses is the dominant person. He or she is the whole business itself. He got the idea and has all the responsibility. He or she managed the business. On the other hand, in these businesses, they need top managers with qualifications in risk management, liquidity, and cost control. The role of chief financial officers required to play a more complex leadership role by participating in the formation of the company's strategy, such as logistics, computing, acquisition, and strategic placement of the company. They control and coordinate the company's finance. Some of their duties are draft the company status, add value to the business with various moves, calculate the operating costs and revenues of the company, participate actively in shaping the business strategy, and so on. Management functions are defined as the process of four basic functions. The process of effective management starts with planning, continues with organization and management, and ends with control, which in turn leads to the review of the programming. Programming refers to what will be done, why, by what means, when will be done, and who will do it. It is thinking before the action. Programming, therefore, includes setting targets and shaping strategic and political operational action programs. Organization, on the other hand, is the combination of a structure, for example, jobs, departments, power relation, and hierarchy levels, procedures and operating rules to ensure efficiency in the business. This function makes it clear who is responsible for the implementation of an action, of the decision making, for the type of producers, and the rules that solve the problems in an organization. Management is the performance in general of the activities as it was stated in the previous phase. And lastly, control is the review of the performance of the management, and it helps to identify if there can be an improvement or prevent risk. The subject of audit in the context of financial audit is primarily the way and reliability of measurements and presentation of the financial figures that constitute the image and the results of the business. In the context of audit, individual functions and systems, as well as the overall organization and administrative structure of the unit, the adequacy of the entire administrative information system can be checked. Thus, control as a function in the wider administration of a society is essentially distinguished by external independent audit, which is the one carried out by professional and specialized trained accounts auditors referred to as statutory auditors. State control. These include all controls exercised and carried out by various governmental and semi-governmental bodies. The most important control of this kind are the tax audit carried out by the tax authorities and concern the search for verification of the taxable incomes of natural and legal entities subjected to taxation. Internal control can be defined as a separated and independent function, which is responsible for the continuous control and evaluation of all the organization systems and operators of the unit, and which functions in the broadest management information system. The main objectives of control systems are the compliance with all procedures and of the policies as set out by the management of the company, the effectiveness of internal organization, the avoidance of fraud, irregularities, mistakes, and weaknesses in the organization and operation, which may or may result in poor management and treatment. Assessing the effectiveness and adequacy of the organization and management system of the unit, and reporting audit findings to the unit's management and suggest corrective or improvement measures where appropriate. Decision-making is a process and not just the choice of a solution between different alternatives. It has 3 stages. Step 1. Identify alternatives. In this stage, there is an examination of restrictive terms. For example, there is no time, no financial resources, or alternative decisions depending on the company's capabilities and capacity. Step 2. Analysis of alternatives. It is the analysis and evaluation of the alternatives appropriate to achieve the goals. Stage 3. Choosing the best solution. Once the various alternatives have been identified and evaluated, the entrepreneur will choose the one that is most likely to succeed. This stage is the culmination of the decision-making process, and it's precisely the stage in which the planning of the various actions for the implementation of the decision begins. If none of the alternatives evaluated are accepted, the manager must restart the decision-making process from the first stage in order to find other alternatives. At the beginning of each analysis, we should take it to define the problem. A problem can be defined as the difference between the current situation and the desired one. Thus, after finalizing the definition of the problem, we can determine its extent, its relation to other problems, its causes, and its effects. A proper understanding of a problem can lead to a better analysis, but also to the most reliable solution. Now, what is included in a financial plan? The balance sheet presents the assets of the company, or in other words, what belongs to the company. and the liabilities of the company, as well as the total investment of its shareholders, which is called liabilities. The balance sheet keeps the company's situation on a specific date. There are 5 basic categories of assets in line with the latest European Union directives. For example, deferred fund, which includes unpaid capital, a category that is not commonly used. Installation cost, including installation and installation cost. Fixed assets, which includes tangible assets, participation in other companies, property of the company in fixed installation, for example, buildings, machinery, furniture, etc. Current assets, which includes what belongs to the company and will be liquidated for the most part of the next financial year. And finally, transactional accounts, that essentially allow for the classification of transit accounts, that is to say, accounts that are to be classified in a subsequent year. On the liability side, we usually see 4 main categories. Own capital, which include the funds paid by the shareholders, the reserves, which constitute funds from profits not distributed for various reasons, as well as amounts from profits, or provisions for risk. And liabilities, including long-term liabilities and short-term liabilities. Transnational liabilities, which, as in the case of assets, actually allow the classification of transitory accounts, that is to say, accounts that are to be classified in a future financial year. You can see an instance of real balance sheet in learner's material. Unlike the balance sheet, the statement of operating results measures how effective the operation of the firm was between 2 specific times, that is, between 2 balance sheets. Thus, while the balance sheet shows the company's financial position, the operating results show how the company functioned at a certain period. In the income statement, each income and expenses is recorded separately as a regular or extraordinary result of the period. This results in the profits or losses of the period that has passed. The profit and loss statements follows. You can see an instance of a real profit and loss account in learner's material. Now, here are some of the advantages of small medium-sized enterprises. Its flexibility and speed in decision-making, its dynamism, creativity of the organization with increased sense of individual initiative and responsibility, its personal relation and acquaintance with the clientele, the good understanding of special customer needs, its quick adaptation to changing conditions, its better and easier flow of information, its innovation in the production of products and services, good at creating new jobs and exploiting the talent, its lack of bureaucracy, good at exploiting local resources, its limitation of overhead costs, and it's indispensable for larger businesses. And here are some of the disadvantages of this type of companies. The big business risk, as it represents an uncertainty about the future, difficulties in the supply of raw materials in terms of price and quality, small production capacity to cover large orders, restricted financial resources and difficulty in the long-term back borrowing, insufficient commercial organizations and sales network, its limited number of specialized executives, no training plan in the department ensures de facto training of the workforce. There are mechanisms to absorb the less favored categories in the labor market, such as women, young, and unskilled workers, and these type of companies are present in the market of the future and in the market folders, less open to international competition, the ownership of capital, their management, and the means of financing them. Thank you. See you in the next lesson.